Hi, I'm John Sviokla, a retired Harvard Business School professor, and I'm here at the Harvard Club in Boston to speak with Professor and Chief Investment Strategist Joel Litman, a forensic accountant and CPA who's lectured at Harvard, Wharton, and the world's top CFA societies. Joel's ability to predict the market's biggest moves has landed him invitations to the Marine Corps War College, the FBI, National Forensics Conference, and even the U.S. Pentagon, where he recently delivered an eye-opening message that will be the subject of today's briefing. In short, if you're worried about the market this year, we have big news for you. After seeing the worst sell-off in half a century, Joel and I arranged to meet today for an emergency briefing. Joel's predictions have brought him to the attention of CNBC, Forbes, Barron's, and more, for good reason. Joel accurately predicted the 2008 and 2020 crashes. He exposed 57 companies for potential fraud, with many that went bankrupt or fell to almost zero after his analysis. And he called the bottom of the 2020 crash with a series of stock picks that could have doubled your money, or better, 10 different times. And now, today, he's sharing his newest prediction, which he believes will lead to an even bigger opportunity. Professor Litman, welcome back to Harvard.
Good to be here, John. Thanks.
Joel, you recently gave a lecture just down the street from the White House to high-ranking U.S. Pentagon officials on what is arguably your most contrarian prediction ever. You say it represents a massive financial disaster headed for America this year, worse than anything we've seen so far, but it's also a generational money-making opportunity that 99% of the public will completely miss out on. And it's all being orchestrated by forces beyond our control. Joel, tell us what's going on.
Well, I'll get right to the point. In short, I predict everyday Americans are about to experience a great deal of financial pain. As we'll explain today, you'll almost certainly become victim to it if you do nothing. And the whole thing is being facilitated by many of the authorities you trust the most, which means that outside of this briefing, you might never even hear about this until it's too late. But if you know what's coming and exactly which investments to make, which we're going to cover today, including a free recommendation of the #1 investment to buy and the #1 to avoid, it's a chance to make a great deal of money, and that's why I agreed to hold this emergency briefing.
Keep in mind, the last time Joel held an emergency briefing was shortly after the 2020 crash. He told our viewers that he was sharing, quote, the biggest money-making opportunity of the next decade, a chance to realistically make 10 times your money on a single investment. If you'd watched that event, you might have dismissed the whole thing as a bunch of BS. But the fact is, you could have made 9 times your money, tripled your money twice, and doubled your money if you had followed him for 123% average gain across all his recommendations through 2020. So Joel, without further ado, let's dive into your newest prediction, because I can say up front, it's unlike anything I've ever taught at Harvard, MIT, Wharton, London School of Economics, all the places where I've been a professor. Tell us, exactly what is this disaster?
So John, most everyday folks I've spoken to are worried that a larger crash or a years-long bear market is on the way, and no wonder, right? I mean, we saw the worst sell-off since 2020. The number of NASDAQ stocks down 50% or more hit a near record. Inflation hit a 40-year high. And of course, the geopolitical conflicts caused this big spike in fear.
Yeah, I mean, the market went up so much after 2020, and we've seen such nasty hiccups since then, that I think a lot of people are expecting to see a big and prolonged decline.
Sure, right, but that's only a small part of the full story. Meanwhile, the experts are saying buy gold because they're claiming that inflation is here to stay, or they're saying buy value or alternative assets because the Fed has been raising rates, right? But I'm here to tell you that none of these issues touches on what's really coming to America this year. There's a much bigger problem headed your way, and it could turn out to be a kind of massive financial heist you've likely never considered before, with an opportunity hidden within that's far greater than anything you can make on gold or ordinary stocks or bonds or crypto, you name it.
Joel, let me ask you up front, this financial heist you're predicting, you don't mean the hackers stealing my bank account information or a run on the banks or a government seizure of personal property or assets, do you?
No. So nothing like that. John, this is a heist that goes deeper than that, and it's perfectly legal, which is what makes it so scary. And the fact is that it's already happened to you on a smaller level if you have any money in the markets. But this year, I believe it's about to play out on a scale bigger than any I've seen in 20 years, since 2003. We've discovered all this, along with every other big opportunity we've ever shared, by seeing what no one else can see about the market, John. And it's something that we personally created, right, which is so effective that our research has been followed by the top 10 global investment houses, and more than half of the world's 300 biggest money managers. In short, we've developed a system.
Today, we're going to have you explain and even demonstrate your system. But one thing I want to mention up front, what you're about to see is the most successful stock predictor I've come across in more than 30 years as a professor and a partner at a consulting firm where I worked with dozens of leading minds in technology. It works especially well during the kind of roller coaster market we've seen lately. For example, back in 2009, when the Dow fell 48%, a room full of wealthy hedge fund managers hired Joel and his team to name their #1 investment ideas. Joel ran his system and recommended Timberland, which went up 301%. Hanes Brands for a 445% gain, Liz Claiborne for an 878% gain, and Skechers for a 1,566% gain. So Joel, walk us through exactly what you've created and what it's saying about the market right now.
All right, so John, first off, consider what happened during the shakeup of 2020. There was this massive exodus out of urban areas as the pandemic swept through America and the housing market boomed, right? So by September of that year, we saw a $1 trillion increase in home equity. Many on Wall Street were saying, buy Zillow.
You mean the real estate listing company?
Right. And fair enough, if you'd bought Zillow during the depths of the COVID crash, you'd have doubled your money. But John, my team and I spent nearly 30 years on and off Wall Street at places like Credit Suisse First Boston, and as certified public accountants at Deloitte and at PricewaterhouseCoopers. And the one thing we've learned is this: if Wall Street is pushing some investment onto the public, there's usually something else they're not pushing that can make you even more money and a lot more money.
You mean that they save the better investment for themselves?
You're right, often, yes. And in fact, I've written exposés about this for Harvard Business Review. It was called Give My Regrets to Wall Street. And another one in Forbes titled Wall Street is Wrong Again. I've been disgusted by the behavior I've seen from Wall Street institutions, and it's why I left that world. In fact, I launched my own firm specifically to build a system to uncover exactly what these little known investments are. And in this case, I ignored Zillow completely, John. I applied our system to the real estate sector, and we came across a smaller and a less talked about company called EXP World Holdings.
And I imagine that company is similar to Zillow.
Similar, but it puts a customer broker platform on a cloud network, and it even creates this 3D virtual experience. This is especially important, obviously, during the lockdown, but here's the thing. When you type the stock ticker into our system, this is what you see.
Okay. And what is all this exactly?
So, John, this is the measure of how successful the company is according to Wall Street. It tracks the one thing that the investment world follows more than anything else, the biggest factor that drives stocks up or down, and that is, of course, the company's earnings.
Okay, so for this company, we're looking at 2019 here, right? And I gotta say, it looks pretty bad. What is that, -7%? So these guys didn't make a penny that year.
All right, so this is the company's return on assets. This is its earning power. It's a measure of how effectively they generate cash earnings against the assets that they have in place. And yes, this was the number posted on Wall Street. But one look at these earnings, John, you would have run away from this company, right? I mean, sure enough, hardly any Wall Street firms were recommending a buy on this particular stock.
Yet, real estate was super hot at the time.
Yeah, so now, John, I'm no expert on real estate. I mean, I've lived all over the world, but what I do know is that Wall Street routinely hides the best opportunities for themselves. For example, the research side of an investment bank will hand ideas to the investment side while telling the public about a completely different idea entirely. This has happened. So when I saw how awful this real estate company looked during a real estate boom with such little attention from Wall Street, I investigated at a deeper level. So in short, I ran the company through the system we're going to share with you today. This is the culmination of my life's work, which our clients pay as much as $100,000 a month to access. And with one glance, I saw that this stock had the potential to rise by 500% or even 1,000% or more. Now, take a look.
Whoa, what is all this?
So, as it turns out, the publicly reported numbers from Wall Street were all completely wrong. There's a massive discrepancy, which I've spent my 30-year career learning how to detect. Our system applies more than 130 corrections to the balance sheets and to the income statements of more than 32,000 companies to find and then correct these discrepancies. So one click, and you can see the true earning power of the company right here. And not only was it was positive to the tune of 110%, as good as you'd see in a company like Apple or Amazon. Now, we call that true blue. So I recommended the stock based on this, of course, in July 2020. And sure enough, you could have made 8 times your money on a recommendation in just 7 months.
So without your system, you and even your entire team of 150 personnel would have missed this stock.
More importantly, the general public would have missed it too. They did miss it, and we see this happen all the time. For example, look, I don't claim to know very much about apparel fads, which we were talking about earlier, but during the shakeup of 2020, our system picked up on a big discrepancy in a company called Movado. This is the watchmaker, right? Movado. So run the stock through our system, and here's the number posted on Wall Street for how successful this company is. It's just 3.3% return on assets. It's not very impressive at all for a measure of Movado's earning power, right? I mean, there are bank CDs that earn that much. But one click, and here is the real, true earning power number. It is more than 2 times higher. And in fact, this discrepancy had been going on for years. So we immediately recommended this company and have seen a 354% gain. Meanwhile, not one buy recommendation from Wall Street. In fact, one bank was actually downgrading the stock at the time.
Hold on. If this company is so great, why would Wall Street keep it a secret?
So they can simply buy the stock for themselves, John. I mean, take another look at Movado. Guess who owns the stock? 93% of its shares are held by institutions, including BlackRock and Vanguard and more. I mean, the sad fact is, Wall Street has been keeping the most successful investments to themselves for decades, and they're able to legally do this through this obscure set of regulations, basically GAAP accounting.
By that, you mean generally accepted accounting principles.
Exactly right, yes. So now I'm going to explain what I mean by that and how that's possible. But the big takeaway here is this. It's the information that is reported to you, to the general public, is not enough to find the best performing investments, especially the kind of jittery market we've been seeing lately. I mean, many of the wealthiest investors are looking at completely different numbers than the rest of the public, which is one reason why you often hear about these high net worth people comfortably putting millions of dollars into a single investment and just walking with double or triple. Or in Bill Ackman's case in 2020, making 100 times their money, while most Americans are just grinding out, in a bank account 2% a year at best.
And that's where your system comes in.
Yes, and that's because this kind of discrepancy has been taking place among thousands of individual stocks for years, John. Right? In other words, extraordinarily valuable information has been hidden from you, from the general public. So to name a famous example, consider all the Wall Street experts who told you to avoid Netflix over the years. One guy at Wedbush Securities said back in 2011, Netflix was a broken company and was totally unfixable. Incredibly, he's urging people to avoid Netflix every single year for the entire decade. Now, run that stock through our system back then, and guess what? The real true earnings numbers for this company, they have been crushing the numbers reported on Wall Street for literally decades, John. This company, Netflix, was minting cash for that decade. Our system picked up on this as far back as 2006. That's when the true numbers were already 5 times higher than the as-reported numbers. So if you'd bought on that information alone and you continued holding, our system continued to show this massive discrepancy. You could have ignored all the noise on Wall Street for a 42,000% gain. Now, guess who made most of that gain?
Wall Street.
Yeah, of course. I mean, 82% of the shares of Netflix were held by institutions. Now, if you think I'm cherry-picking Netflix, take a look at this one. Here's a lesser-known company ranked 5th. This is 5th behind Netflix as one of the top 30 all-time greatest stocks in the S&P 500 over the past 30 years. You know what it is? Pool Corporation. This is a swimming pool supplier.
Okay, and I assume that these are the publicly reported numbers from Wall Street.
Yes. All right. So now, those are the numbers. Now, those are as reported. Now, with one click, run the stock through our system. Now, here are these are the true earnings numbers, right? The true blue. Consistently higher, John. And surprise, surprise, 95% of the shares are held by institutions who are looking at the better numbers. They're seeing the real numbers, and they're seeing it long before the investing public, the general public, does. But if you've been able to access that information at the same time as Wall Street, and you'd gotten it at the beginning, you could have made a 63,727% gain on this stock, John. That turns every $5,000 investment into over $3 million.
Got it. So Wall Street can see that certain companies are generating way more cash than publicly reported, which eventually, maybe a quarter or two or even a year later, results in some big earnings surprise in any kind of market.
Yes, exactly. Because cash is king, and it's all about that earnings surprise that represents the cash that's going to be generated or is being generated by the firm.
Yeah, but it all seems so unfair that only the wealthiest institutions have access to this information. And of course, they couldn't really care less about you unless you have about $100 million to invest or more, which I assume is the biggest reason they keep all of this to themselves and their wealthy clients.
Right. Yes. And John, look, I know you're a partner. You're a partner at one of the biggest consulting firms, which whose stock went up from a few bucks to a peak of $100. So I know you've seen all this stuff firsthand.
105, yeah.
Right. The bias by Wall Street is there, and it's geared towards super high net worth individuals.
Of course. And meanwhile, the general public is stuck with the info posted on Yahoo Finance or in the 10K filing, which could be totally inaccurate from what you're telling me. It's really BS.
It is. John, it's totally unfair. It is absolutely unfair, especially when you consider how much it costs to calculate the true earnings numbers. I mean, in our case, it requires a team of 150 people spread around the world, right, working 24/7, including many CPAs and CFAs on 3 different continents, and they're breaking apart the balance sheets and the income statements, and believe it or not, the cash flow statements also, and breaking them down for 32,000 companies and adjusting over 130 of the different line items for all of this. Right? The labor cost is so high that the institutions that don't want to do this work themselves, they'll pay our firm over $100,000 a month to access it. In fact, one hedge fund manager actually paid us, this is one of my best, paid us $100,000 for a single research report on a stock he owned, and I think he ended up making well over 20 million, 25 million profit on it. Now, great for him, right? But how does the average American afford that?
Yeah, got it. And that's why you're stepping forward today.
Yes, that's what I'm doing. So what I've just shown you on a variety of individual stocks amounts to nothing less than a massive campaign of misinformation by Wall Street that keeps you and the general public out of the best performing investments. It does. And now, the same thing is about to happen. It's going to happen on a scale so wide, in such an unexpected way. It really is a financial disaster for most people. But also, John, it's a huge money-making opportunity if you understand what's coming.
And with that, let's get right into the details. What exactly is Wall Street not telling the public right now?
All right, so to start off, I want to show you something. These are the biggest corrections in the S&P 500 since the crash of 2008. Essentially, these are all the mini crashes we've been seeing over the past decade. So these are scary numbers, wouldn't you say?
Yeah, I remember a bunch of these. I mean, heck, the one in February 2020 was the worst one-day drop ever at a time.
Scary enough to see a big pullback like this, all right, in the market. But you know what makes it even scarier? All the Wall Street experts who take to the media to predict that doomsday is coming. For every drawback you see here, the financial TV outlets, the mainstream financial media, and the internet were polluted by some, frankly, very smart and successful people calling for the end of the bull market. Now take a look. April 23, 2010, we see the start of a 16% drawdown, and the New York Times quotes a senior analyst at Standard & Poor's asking, should we set a place for the bear at the 4th of July barbecue? And as it turned out, the 4th of July is exactly when the market turned around and proceeded to all new highs. Oops, I guess he was wrong. Here's another one. September 20, 2018. We see the start of a 19% drawdown, which culminates in the Christmas crash of that year.
Yeah, that was the worst December for the market since the Great Depression.
It was, and Forbes ran a piece by a Wall Street veteran claiming the 2018 downturn will lead to a historic decline. But we urged our clients to buy the freaking dip. And as it turned out, this is what my clients always say when I see them. They're like, are you telling me to buy the freaking dip? And you know. So in 2019, the market saw its best year in 2 decades, John. All right, you see a pattern.
Yeah, I bet you could walk us through that entire list of downturns and show all the fear being spread by Wall Street.
I could, and that very easily. My point, of course, is that the market went on to soar after every single one of these downturns. And not to mention, if you'd known which stocks to buy during these subsequent rallies, not just the market, but the right individual stocks, you'd have forgotten all about that fear. All right, for example, during 2010, that 2010 decline, our system pointed to NVR. This is a home builder. Before it rose 732%. During the 2015 decline, we were recommending AMD, the chip company. Our coverage even got picked up by Barron's, and we saw a 6,000% gain. Look, the simple fact is, if you're able to see the real, true numbers behind a stock, which is what our system allows us to do, there's always a money-making opportunity in any market, bull or bear. And right now, our system is pointing to a massive distortion in the overall stock market, which is going to catch a lot of people by surprise.
Before you go on, because I know you've got a whopper of a prediction to make about today's market, using your system, how can these distortions exist? I mean, to your point earlier, how can Wall Street legally get away with posting the wrong earnings numbers? That just doesn't make sense.
So take United Airlines.
Yeah.
This is one of my favorite examples. So John, run this stock through our system, and here's what came up back in 2009. This is right after the crash.
Yep.
So Wall Street was posting a 0.8% return on assets. That was the earning power, which is terrible, right? It's almost zero, right? And yet, that year, my team and I had lunch with 10 of the top US hedge fund managers, and we were urging them to buy United Airlines. Now, why? Because with one click, one could see the real, true earning power of United Airlines, and it was almost 4 times higher, 400% higher. This means we were confident the stock would eventually be trading higher as more and more people realized this company was generating a lot more cash than you'd have believed by reading the as-reported financial statements. So in this case, we saw the numbers before the top hedge fund managers did by simply applying our system. But this case, they ignored us because they were still looking at a different number that had been reported on Wall Street. Now, was Wall Street lying to the public about United Airlines? No. Everyone was just everyone was using the standard accounting rules, GAAP, which are just a mishmash of overly complex, totally unclear, and antiquated rules that result in huge distortions of what's reported versus the economic reality.
You know, I've heard you speak about this before, and it's just amazing. Essentially, the entire earnings system on Wall Street is beholden to a form of accounting that's completely flawed. I mean, even Warren Buffett has spoken about this inaccuracy of the GAAP accounting system.
That's right. I mean, John, Buffett has opened 3 of the most recent annual shareholder meetings, the big Berkshire Hathaway meetings where Buffett and Charlie Munger get up there and talk. And he opened in the first 10 minutes railing against the problems with GAAP accounting, right? Even a colleague of mine, an NYU business school professor, has said very publicly, based on extensive research, reported earnings are largely detached from reality and they don't really matter much. And that's because altogether, there are over 130 inconsistencies within GAAP accounting that cause earnings for every company in the United States to be distorted each and every quarter. All right, what does this include? This is like whether you depreciate expenses. Do you depreciate on 5 years or 10 years or 20 years or even in some cases fail to amortize at all? This changes, right? It's a giant distortion. Debt often gets miscategorized. Sometimes it's on the balance sheet. Sometimes the debt is off the balance sheet. And hundreds of non-cash items that flow through the financials and even flow through the statement of cash flows, right, that distort the company's true earning power, its true cash generating power by hundreds of %. And that's why over decades, my team and I developed this system based on forensic accounting that allows us to see the real, true numbers weeks and even months before the public or even some of the smartest money managers have any idea. Now again, John, this is why more than half of the world's 300 biggest money managers have been clients of ours. They don't want to do this work themselves, or more likely, they can't because it can take weeks to audit a single company, and they're happy paying us up to $100,000 a month to do it for them. Because again, our average gain for 2020 alone on the kind of investment we're recommending today was 123% on average. Yep. John, do you know what happens to your portfolio when the average of every single position more than doubles in value?
It's a beautiful thing, that's for sure. So the numbers you find are often multiple times higher or lower than what's reported to the public.
Yes. So in the case of United Airlines, they had $764 million of earnings from its acquisition of Continental Airlines that weren't even showing up on the income statement at all. That is acquisition accounting. It's a mess. And that made the company look a lot less profitable than it really was. If you'd bought and held following our system, you could have made 4 times your money overall on that.
Got it. So to be clear, United Airlines wasn't doing anything illegal per se.
No.
They were just following the required accounting rules, which can place literally billions of dollars of debt or receivables or investments into the wrong category of the financial statements, causing assets and earnings to be hugely distorted from economic reality.
That is exactly what's happening. And so if you can spot all this, before the market corrects for it, while it's totally unknown to 99% of the investing public, of course you gain a huge advantage over everyone else. Now, here's the kicker, John. Many on Wall Street, they know all about these distortions, and they're using that information to their own advantage, making no attempt to share this with the public. Right? I learned this firsthand when I was at Credit Suisse, and that just gets to the entire prediction I'm about to share with you. And it's what I consider a true financial disaster that's headed for everyday Americans. In short, I don't think we'll see a years-long bear market or a long, drawn-out recession at all. There'll be some big drops for sure. There's going to be volatility. But we've already seen, right? We've already seen this. Ultimately, as I'm going to demonstrate today with our system, we are headed for a massive and sustained new phase in an overall bull market, which nobody on Wall Street wants you to know about, because it could cause one particular type of investment to skyrocket, and they want to be there first. So don't expect anybody in the media to tell you about it either. But this little talked about investment we're sharing today is the number one place to put your cash immediately, especially at today's historically cheap prices.
Okay, but wait, if you're not predicting a long bear market, how is that a financial disaster?
John, I'll tell you why. Now, consider Apple, for instance. Back in 2010, this is the return on assets posted by Wall Street. Again, a simple measure of how successful the company is. It's about 18.7%. Now, is that impressive? It's all right, right? But it's not enough to get you very excited. I mean, so for example, Disney posted the exact same number back in 2018, and the stock has done nothing since then. What really matters is how big the discrepancy is between that reported number and the real true earnings number that we determine using our forensic accounting. So the bigger the distortion, often the bigger result you can see by acting on the stock.
Well, let's run Apple through your system.
All right, so one click and boom. This is the real true number for Apple back in 2010, the year they first released the iPad. It is almost 7 times higher. This is a huge distortion. And yet Wall Street didn't correct the number at all, not for the public, right? This amounted to an entire campaign of misinformation that would cause you to miss the 2,500% gain, 2,500% gain that Apple has seen since then. I mean, to miss that kind of money-making opportunity during what was, at the time, a historic bull market, especially when you're getting close to retirement, this amounts to nothing less than a financial disaster, with the cost of living getting higher, and pension funds a mess, and Social Security extremely underfunded. You simply can't afford to be looking at the wrong numbers and be missing potential 10-baggers exposed by our system in either bull or bear markets. All the things you need for retirement, whether it's real estate, healthcare, and so on, they're all getting more expensive. And millions of Americans aren't going to be able to afford these things because they won't have as much money as they should. They're missing out on the best gains in the market. And the sad part is Wall Street banks and these big funds, they want you looking at the wrong numbers because while they're growing wealthier, right, they have the correct information.
Was that true of Apple?
Sadly, yes. So more than half of its shares, of course, held by institutions who think nothing of spending the $100,000 a month it could cost to get the real, true numbers behind the best companies, because they know how valuable this is. We've seen this time and again over the last decade on individual companies, as we've discussed so far. But today, my research shows it's about to happen across the entire market on a historically wide scale and across one particular category of investment most people, John, aren't even considering right now. Mark my words, missing this opportunity in the coming months will be the greatest financial mistake of your life. If you miss the bull rally that followed the COVID crash that we were calling for, this is your wake-up call to take action now.
Okay, but Joel, some critics might say, how can you be so sure that we're headed for another leg up in the bull market? The market has been a mess, and wasn't Apple a rare exception?
So this is exactly my point. If you used our system and been confident in the bull market that began in 2009 and been looking for the best stocks, Apple wasn't the only pick. Now take a look. Throughout the early 2010s, we urged our clients again and again to buy stocks. Along the way, our system pointed to a casino company called Penn National Gaming, which had 110% earnings distortion. It was that much better than what the public was seeing. That was in 2010. A distortion that continued for most of the next decade. If you'd bought and held, you'd have made up to a 1,785% gain among dozens of other examples. And here's the kicker, John. Back in 2010, Penn Gaming belonged to exactly the category of investment I'm urging you to buy right now.
Okay, now I want you to explain this little talked about investment you're recommending today. But again, Joel, why so bullish? The market's been a huge question mark lately between geopolitical conflicts, the Fed, inflation.
John, it's all noise. Now take a look. We've applied our forensic analysis system to the entire stock market to correct for every distortion in every single company that makes up the S&P 500. Now, essentially, we created our own S&P 500 index, but using the correct numbers. And guess what? Even before the sell-off, stocks weren't nearly as expensive as people believed, and the sell-off has made them even cheaper. So the reality is, this is the moment you've been waiting for, when some of the world's greatest companies have essentially gone on sale due to entirely media-driven fear, especially among the category of investment we're going to discuss in a moment.
But what about the Fed raising interest rates so much? A lot of experts are certain it's going to cause a historic recession as all of that easy money dries up.
All right. The idea that the Fed raising rates will lead to a huge crash is exactly the kind of nonsense that Wall Street peddles and the mainstream media wants you to believe. It is nothing but a myth. It's pushed on the public to create fear and to generate click-throughs and get more viewers, because nothing sells better than fear, as you know, right? You want to know the reality? Rising rates do not kill a bull market. Look, take TransDigm, for example, an aerospace company. Back in 2016, the Fed raised rates. If you'd been scared about the market, right, you'd have avoided the stock, which our system pointed to as a strong buy because it had such a gigantic 571% earnings distortion. The company was much, much, much better than was being reported. Since then, you could have tripled your money.
And I assume that's not an isolated
No,
case.
of course not. I mean, it's because history shows that the Fed raising rates often leads to gains in the S&P 500, not crashes. For example, the Fed hiked rates 17 times from June 2004 to mid-2006. Meanwhile, what did the S&P 500 do? It soared during that period, rallying 34% before its peak in 2007. And the Fed hiked rates from 2016 to 2020. But the S&P during that time, what did it do? It doubled, despite all the fear and jitters along the way of the Fed raising rates.
So all these Wall Street experts are causing panic for really no reason.
Right. So the Wall Street media, and let's face it, that's all Wall Street research really is. Wall Street research is just media. It makes money by generating more views and more attention. Meanwhile, the smart money on Wall Street, meaning the big hedge funds, the institutions, they very purposely hide what they know. They're not running around telling the general public this. And so the general public is left seeing the sensationalist, ad-driven headlines, and they never get to hear the truth that's behind the really smart money. You'd have to be worth $100 million for Wall Street to even consider you as a client. But one click in our system, and here's everything you need to know about what all that fear in the market is saying right now.
Okay. And what is this? The cost of borrowing money?
Yes, right? What kills bull markets are credit problems, John. Hundreds of years of economic cycles bear this out if one just takes the time to look, which of course the mainstream financial media simply does not, right? So today, the amount it costs to insure yourself against a bond default, this is known as a credit default swap. It's barely above levels from the last bull market. In other words, the smart investors, they aren't panicking over credit despite all these interest rate hikes. So for example, the last time we saw credit default swaps this low, the cost of insuring against a bond default, our system pointed to Natural Health Trends Corp, and that was before the stock rose 4,691% in just 2 years. This is the kind of gain you could soon miss if you get sucked into this unreasonable Fed story, or the inflation story, or the geopolitical conflicts, right? This recent sell-off is nothing more than that, and it's a natural and healthy correction.
So tell us, what do all the stocks you've named here have in common?
John, they're all small. I mean, look, you could do fine in a bull market owning blue chips like Walmart, but the stocks we like have the potential to rise 5 to 10 times higher for a simple reason. They're a fraction of the size. So in other words, imagine if you could have bought Walmart when it was still small, before it rose hundreds of percent. Take the 2020 bull run, for example. You could have bought Moderna, right? The vaccine maker, which was an obvious candidate for stocks that would do well as America recovered from COVID-19. And sure enough, it had a big earnings distortion. In fact, earnings reported as negative on Wall Street, when really they were cranking out cash, and you could have more than doubled your money following our system.
But I take it you didn't touch Moderna.
All right, no. I mean, for us, the company was just already too big. Instead, we played the COVID-19 recovery by applying our system across the market, looking for smaller companies whose story was being obscured by Wall Street and the media, and we found a company called RCI Hospitality Strip Clubs.
Strip clubs? During a pandemic?
I know it sounds funny, I know, but almost half of the shares were being held by Wall Street, the smart money in Wall Street. And even as experts said that this business model would be doomed by the pandemic, we knew Wall Street was keeping this one for themselves. So we ran the stock through our system and wrote, our upside is 443% higher from today's levels.
That's a pretty bold prediction.
And sure enough, the stock is up as much as 464%, sits on recommendation. This is 5 times your money.
So to be clear, you're recommending microcaps. Didn't Warren Buffett say he could make 50% every single year if he could buy microcaps?
Yes, but a very particular type of microcap. So in short, we're urging you to buy small companies that have massive earnings distortions, and especially in one sector. And that's because I believe the public is dramatically underestimating how strong the earnings growth will be in the coming months, regardless of what's happening in the overall market or the economy. And this will be most obvious in the smallest stocks. So for example, take another look at RCI Hospitality. It had 191% earnings distortion when we found it. That is a big, big distortion for a company of that size.
Okay then, which sector should I be looking at right now?
First, let me tell you what sector it's not, John. It's not gold. In fact, I'm telling you, avoid gold for sure.
Why?
John, everyone's talking about inflation, right? I mean, the Fed printed $10 trillion to keep the economy afloat during lockdown. Many people believe that higher stimulus means higher inflation from all the new money pumped into the system. And inflation has reportedly hit this 40-year high, which should theoretically be driving up gold, right? But here's the thing, John. The inflation numbers are totally misleading. People are forgetting that this inflation, what we're seeing now, is driven by demand and not just this money supply issue.
Joel, explain what you mean by that.
John, the untold story right now, and it's the main reason why we're bullish, is that something bigger is driving this so-called inflation. Yes, inflation is up. I'm not disagreeing. Only because the lockdowns caused people to stop spending as much on services and to spend on some tangible goods instead, and this has caused a major supply chain problem.
Because delivery trucks couldn't go anywhere.
Not entirely, no. So you see, tangible goods require getting factories up and running, and what people don't realize is that this new surging demand has exposed a long-standing problem with most U.S. corporations. In short, we don't have enough factories. So the chart of PP&E ratios, this chart, tells the full story.
So Joel, tell us what PP&E is.
All right, so plant, property, and equipment. It's a balance sheet line item. It's total of the balance sheet representing companies' large physical assets.
Like a manufacturing facility, for example.
Right, right. And this chart shows how incredibly old these assets are right now in America. So over the past decade, most U.S. companies simply weren't coughing up the cash to renovate their factories. They limited their capital expenditures, this is known as CapEx, to maximize their cash flows, which makes sense, right? I mean, nobody ever wants to replace equipment until they absolutely have to. But today, with this surging new demand post-COVID-19, this is now creating supply chain issues where supply just can't ramp up fast enough to meet demand. And that means prices go up, but not in the serious long-term way that most experts are harping on right now.
So what we're seeing is really not inflation in the classic sense of that term.
No, it isn't. And this is good news for the market, John, because my research is showing it's going to cause what we call a CapEx supercycle. It's a supply chain supercycle on a scale bigger than we've seen in basically 2 decades. As more factories get online, they buy more from the suppliers, who buy more from their own suppliers, and so on, creating this fantastic trickle-up effect that will lift hundreds of companies with it, especially the microcaps we're targeting with our system right now. And these stocks have 500% to 1,000% potential upside.
Give us an example.
All right, so John, Silicon Motion Corp. So they help make semiconductors, where silicon is crucial. Silicon has seen rising industrial demand in recent years, even before the pandemic came along. So in the US, corporations have been unwilling to invest in the CapEx, the capital expenditure needed to ramp up capacity.
And we've seen a supply chain problem because of that.
Right. And it's been a problem for the last decade, John. I mean, back to literally 2011. So run our system across the semiconductor industry, and here's what you'd have seen back then. This major earnings distortion for this little semiconductor company, a distortion that continued for the next decade to the tune of 105% discrepancy at one point in 2016. It was that much better a company than everybody was seeing. So if you'd seen this back at the beginning, John, and bought and held the stock, you'd have made up to 1,605% return. That's the power of finding microcaps with huge earnings distortions at the start of a CapEx supercycle.
So when was the last time America saw a CapEx supercycle?
2003. Now, remember what happened to stocks after that? It was a straight march higher. And along the way, our system pointed to 140% earnings distortion in Decker's Outdoor Corporation. Deckers, I mean, they make footwear, exactly the kind of staple that benefits from a manufacturing boom. And sure enough, if you bought in at the start of that CapEx supercycle and held through 2008 when the cycle ended, you could have made 11 times your money. And the funny thing is, the distortion continued even after the CapEx supercycle ended. So if you'd seen that with their system and you just kept holding, you'd have made up to 28,000% by 2021. That makes you a millionaire in a $4,000 investment.
You know, this seems like a remarkably simple way to cut through all the noise and see why certain stocks can keep you marching higher with your portfolio. And yet, I haven't heard anyone in the media talking about this.
Nope. Wall Street would much rather you just freak out, you buy worthless gold mining stocks, than potentially make 11 times your money playing the real story behind these rising prices. Mark my words. Companies like this in a variety of industrial sectors are going to lead the way to the biggest gains in the market.
Incredible. I love it. Now, in a moment, we're going to hold a demonstration of Joel's system. He'll type in the tickers for a variety of different stocks and show you what the forensic analysis is saying right now, including the name of a small cap stock you're likely to have never heard before, which he believes could make you multiple times your money in the next leg of the coming bull market he predicts. You'll get that ticker free of charge in just a moment, along with the #1 popular stock to avoid. But Joel, what I'm still marveling over is how sometimes your system knows more about a company than even you or your team. For example, earlier today, I was playing around with your system, and just for fun, I typed in Zoom. As we all remember, Zoom became a household name in 2020, and the stock rose 730% on the strength of its 300 million new users. But get this, Joel's system detected an 814% earnings distortion as far back as 2019, before the first case of coronavirus had even been reported. So, Joel, how could your system have pointed to such a huge winner back when Zoom was just another tech company?
So, John, this actually leads into the entire secret of how to use our system to find the biggest gains. Here's the corrected return on assets for Zoom in 2019. This company was already minting cash even before the pandemic. What that means is, if the coronavirus had never happened, this stock would likely have still had a very nice run in 2020. Now, so what happened to cause a spike? In short, a major catalyst, a reason for everyone to start paying attention to its much better earnings than were reported.
Which in this case, of course, was the new digital shift forced upon the world and the American workplace by lockdowns.
Right. And all of a sudden, people realized just how much cash Zoom was capable of generating, which was already better than the number posted on Wall Street. Now, those two factors combined, the distortion and the catalyst, led to that remarkable 730% gain. So ideally, John, when we apply our system, we're looking for a particular event that will drive attention to the earnings distortion. So in the case of Zoom or Peloton or Ring Central, it was the pandemic. In fact, we published a report in May 2020, and it was called The At-Home Revolution. And it was all about these earnings distorted stocks that would also benefit from the lockdown, each of which could have made you a fantastic gain.
Got it. And that gets to the earlier point we talked about. that the payoff to finding these distortions is an earnings surprise when the world wakes up to how profitable these companies truly are.
Exactly. And still, cash is king. What our forensic accounting system does, it's measuring the cash earnings far better than GAAP accounting. And over time, what happens is GAAP accounting eventually catches up. So that means sooner or later, the reported profits do catch up. And that's when even the general public will see the true number, right? But when that happens, right, the results will surprise even the investing public, and it could cause a huge upward correction in the stock price. And a good example of this is Solar Edge.
Okay, and that's what? A solar energy company you recommended back to your readers sometime in about 2019.
Yep. So what caught our attention first was the earnings distortion. So according to our system, the true earnings were almost 3 times higher than what Wall Street was reporting. And that alone got us excited. But 2019 was also the year when renewable energy started to become a very hot topic. So one thing in 2019, the US consumed the highest amount of renewable energy on record.
So in this case, it had both of the things that you look for, a distortion and a catalyst.
It sure did. So the following year, it delivered a 40% earnings surprise. And what happened? You could have more than tripled your money on the stock. So, but as impressive as that might be, I promise you, this CapEx supply chain supercycle will be a far greater catalyst. And I believe the stocks uncovered by our system are going to be the best way to play it.
So your system is kind of like having a real-life crystal ball. You get to see into the future long before other investors for the chance to profit as the public catches on to what you already know.
Well, call it what you want, but the bottom line is that finding a small stock with a huge earnings distortion at the start of a catalyst as big as this once in a 19-year CapEx supply chain supercycle we're seeing is likely the greatest wealth building opportunity you're going to see over the next decade. And ignoring this opportunity because all these Wall Street experts and mainstream media have scared you onto the sidelines, John, this would be a disaster for your portfolio.
Well, I'm excited to get the name of your free microcap recommendation to play all of this, along with the #1 stock to avoid. But right up front, though, I got to ask the obvious question, Joel. What if I'm still terrified of a much bigger crash or a bear market this year?
John, the bigger danger for most people isn't a market-wide crash. It's a crash within a particular company or sector. Because remember, John, individual stocks can collapse all the time, even at the height of a bull market. This is why we love using our system to expose the worst stocks. So for example, back in 2020, we published a report called 10 Microcaps You Must Avoid at All Costs. And inside, we warned about Bright Mountain Media, which went on to plummet a full 100%. Canada Corp, which plummeted 81%. And Rockwell Medical, we told people stay away, which plummeted 73% among a bunch of others.
And you say that this works on entire sectors as well?
Yes, and so consider electric vehicles, for example. So one standout is the company NIO, which made headlines in 2020 for its electric vehicle buses. So it sounded like a great stock to some people, but I want you to look at this, please. Run the stock through our system, and in 2020, the publicly reported return on assets was negative 8.3%. So in other words, it's already a huge red flag. Now granted, you might have told yourself, well, electric vehicles are so hot, who cares about one bad year, right? Well, one click, and John, here's the real true number. It was actually more than 3 times worse than the number that Wall Street was reporting, and you'd have believed. The result, the stock plummeted 57% in 2021, smack in the middle of that bull market.
Okay, I got it. So the real risk right now isn't necessarily a sustained market-wide crash. It's a crash within particular sectors that have grown too popular or individual companies with earnings that are far worse than the public numbers.
Exactly, John. That's correct. So don't worry about the market. Worry about your individual positions. And I also want you to remember this, John. No market ever goes up in a straight line. So during the dot-com boom, remember that? For example, the NASDAQ saw 5 declines of roughly 10% during its final push higher.
So, as your friends would say, buy the dip.
Yes. And when I visit my clients at some of the top 500 biggest financial institutions, that is the first thing they say to me. They say, you're going to tell me to buy the freaking dips, aren't you? And look, the answer is yes. Because if we find a stock with that earnings distortion and the catalyst behind it, and the stock hiccups because of inflation or some geopolitical force that affects the entire market, but not really that company, That is a buying opportunity, plain and simple. I mean, look, some folks could have doubled their money on our Corn Ferry recommendation in 2019. But if they'd bought more on the dip in 2020, they'd have made an extra 116%. Folks could have quadrupled their money on our Generac recommendation in 2019, and they made an extra 129% if they'd bought the dip in 2020. I could keep going on, John, but yes, as my clients say, buy the freaking dip.
Okay, but I always warn my students at Harvard, some things can never be predicted. For example, say you have a little biotech firm developing a new drug to treat cancer. Unless you're a scientist working at the company, it's impossible to know if the FDA will approve that drug, right?
So you would think so, John, but we've seen amazing results with even the most inscrutable companies because, again, sooner or later, a company with a major earnings distortion will see a correction in the stock price. All right, so consider Illumina, right, in healthcare, for example. This is a company that does DNA analysis. And in the early days, nobody really knew what would happen next, right, with DNA research. But I want you to watch this. Run the stock through our system.
Wow, is that a 300% earnings distortion as far back as 2006?
John, this company was minting cash. At one point, its true earnings were 5 times higher than the number reported on Wall Street. Of course, there was still no telling if gene therapy would ever gain this mainstream approval. But all you had to see were the big earnings and realize all the attention on gene therapy was an ongoing catalyst. So sure enough, you could have made 4,570% gain. The bottom line, just by focusing on the true earnings, you can accurately pick up on some of the biggest stock moves, sometimes years before the story appears in the press. And that's why some people pay us as much as $100,000 a month for our data.
So essentially, the system does all the thinking for you.
John, we call it the altimeter. Because for us, altimetry is the study of, I guess, how high things can go. I wouldn't say the system does all the thinking, but I'd say the system finds which companies will surprise the public with earnings, which, for better or worse, only the wealthiest people on Wall Street typically have access to.
Is this also true of major trends, something like crypto?
Well, so consider what happened back in 2017. Cryptos were so hot that some of the smallest companies tried to cash in on the hype just by adding blockchain to their name. I don't know if you remember that company called Long Island Iced Tea. Long Island Iced Tea, and they changed their name to Long Island Blockchain Corp. And this nonsense actually worked. The stock soared 200%. Wow. Now, 4 months later, no surprise, the investors who bought on that got wiped out when the stock crashed 90% down. Now, consider this. Suppose you run our forensic analysis on Long Island Iced Tea / Long Island Blockchain before you got in. You'd have seen that the company's income, which had already been negative, had actually gotten almost 3 times more negative over the previous year, and you would have completely avoided it.
But there's a flip side to this story, I take it.
All right, so there is. So in this case, John, by using our system, you'd have seen that another company entering the crypto sector for the first time was actually the real deal, and that was NVIDIA. Now, people knew him as a chip maker for the gaming industry, but in fact, back in 2017, that same year that all that Long Island Iced Tea, Long Island blockchain nonsense, NVIDIA issued a chip specifically for crypto miners, and they're consistently pulling in higher earnings than publicly reported, up to 3 times higher than what Wall Street was telling people.
And how long had that discrepancy been going on?
John, since 2006. So among other reasons, they recently underreported earnings by $1.3 billion because of how the stock options are so wrongly treated in that they get this non-cash number in the financial statements that throws off the number, right? This stock, they didn't have the hype of all the blockchain wannabes that made all the headlines, but if you'd seen its true earnings during the 2017 crypto boom and bought in on that catalyst, John, you'd have made up to 11 times your money. And get this, if you'd seen the distortion at the very beginning and you bought in, way back when, you'd have made up to 8,593%.
Amazing. What is that? 86 times your money about? So for you, it's more about seeing what no one else can see, whether that means avoiding the garbage or finding a better way to play a popular new sector.
Yes. And John, this is why the FBI, why law firms, why some of the biggest hedge funds in the world have invited us to their headquarters to show them how we do this type of analysis.
You know, it almost seems unethical that the government abides an accounting system where only the banks or wealthy investors get to see which stocks have a real chance of making you money.
John, I couldn't agree more, right? But there's a way to use this to your advantage because the fact is each of the best microcaps have a tipping point, right? It happens at exact same point in time for each company, and that's when they cross this $500 million mark.
You mean when the stock market capitalization passes 500 million?
Yes. So remember, Wall Street knows how valuable it is to find these distortions, right? Especially on small stocks. But in many cases, legally and practically, they can't actually touch them until they attain a market cap of at least 500 million. So they keep these stocks on a watch list, waiting for them to grow big enough to pass that $500 million mark.
So Joel, why is that? Why can't they buy them before that?
So there's a section of U.S. law dating back to 1830 called the Prudent Man Rule, which actually has some roots here at Harvard, right? That forbids pension fund managers and other large institutional managers from investing in microcap stocks smaller than 500 million. The idea is that a prudent bank shouldn't be pouring money into a stock that can experience huge, huge swings that microcaps can have, right? And with most microcaps, that's true. But of course, not with the ones where you can see they're destined for massive earnings growth. So Wall Street has to wait on the sidelines. They're basically drooling over these stocks, right? Meanwhile, by using our system, you could actually beat them at their own game and get into these stocks before they do.
Wow, that really is a huge advantage. I mean, if you knew one of the biggest hedge funds in New York was about to go all in on some microcap, you'd want to get the money in there first.
John, nothing can make you richer than getting a piece of an unknown stock ahead of the smart money on Wall Street. Essentially, these microcaps with a huge earnings distortion, they receive a kind of boost by Wall Street that can propel the stock as much as 100% on just that new money, that flood of institutional money alone. Now, take Intuitive Surgical, ISRG, for example.
Okay, looks like a pretty major earnings distortion back in 2003.
Yep, and if you'd bought the stock on just that information alone, with no Wall Street coverage at all, you'd have made 75% by year's end, just from the steady trickle of money that any company with good earnings is going to attract, right? It's not bad. Meanwhile, that distortion continued into 2004, and in that year, that's when the stock officially crossed that $500 million mark.
Just from their natural growth.
Yes, but the second it crossed 500 million, it's like flipping on a switch. The stock starts appearing on every screen on all these money managers across Wall Street that couldn't buy it before. And for the first time, the institutions now can legally and practically buy the stock. So within 2 years, that stock rose another 800%.
Wow, that's simply amazing. And with this extra boost, it's all a result of Wall Street money that can finally flow into the stock.
That's exactly right, yes. So the earnings distortion continued, which helped drive the stock even higher and higher. And this is where the microcaps really get exciting. Because $5,000 in Intuitive Surgical 17 years ago would be worth more than $1 million today. And along the way, 5 different banks on Wall Street downgraded the stock during that time, John, including Goldman Sachs.
Wow, you really can't trust the banks at all, can you?
Not if you want the chance to make serious money. You cannot trust Wall Street research. Now, imagine getting a potential boost like this on almost every successful microcap stock you find, and you'll see why some people consider this approach the biggest secret in U.S. finance. Now, for example, consider Intercept Pharmaceuticals. In this case, you could have received a 779% boost when it crossed that $500 million mark. Bluebird Bio, a 740% boost. Intelsat, a 435% boost, and more. Just take a look.
When did you first realize that Wall Street was keeping all those opportunities to themselves?
You know, John, it was back when I was working at Credit Suisse, I was finding all kinds of these mistakes, right? These correction issues. Take Regions Financial, for example. Back on March 7, 2012, our team found a 460% earnings distortion in this banking company. In this case, the company had $86 million that was being miscategorized in after-tax items on the income statement and across the balance sheet. It's an embarrassing mistake not to catch that because it made the company look far less profitable than it really was.
I know you worked with 2 of the original authors of The Gap Guide, so you must have found mistakes like this all the time on Wall Street.
I did, John, and as far back as 2006, I was urging my old boss at Credit Suisse to prevent some of these mistakes like this from going public. After all, if a company like Regions Financial is one of your clients, wouldn't you work hard to catch these mistakes? Right? I mean, I thought so. So I built a system for detecting these financial red flags, and I actually received a US patent for the basis of that system. But to my surprise at the time, the bosses at Credit Suisse, they just buried it.
What exactly do you mean when you say buried it?
I mean that none of the heads at any Wall Street bank, not just Credit Suisse, at any Wall Street bank has any interest in fixing these mistakes on the financial statements of companies that are essentially their clients on the banking side, these multi-billion-dollar clients. It's not just Credit Suisse. Nobody on Wall Street is interested in doing this, right? This completely floored me at the time. I was so naive, right? So I chose to study accounting so I could get to the real underlying performance of a company, to understand the numbers. And what's the point of doing all this research earnings if the numbers end up being misleading anyway?
And that's when you realized something darker really was going on?
Something very dark. So in short, Wall Street just doesn't want these distortions to be fixed. They don't want people to see these red flags, right? They don't. Money managers are fully aware of these distortions, John, and they routinely take advantage of them for their own profit, both long and short, both buying and selling. So in other words, banks and money managers, they thrive on the fact that these earnings issues, these earnings mistakes, these inconsistencies caused by standard GAAP accounting, right? They thrive on it because it allows them to see really which stocks have the highest potential to rise 100% or more before any of the general public has a clue. And it's especially true in the microcap world, and especially during a big shakeup like we've seen recently.
Wow, is that really ethical and legal?
Well, it's perfectly legal. Is it fair? Well, it's a different story. I personally don't think Wall Street should have exclusive access to this information. So anyway, I left Credit Suisse, not a surprise, given that the title of my Harvard Business Review article that I published while I was there was called "Give My Regrets to Wall Street." It's not exactly a, thriving recommendation for where I was working. I know you've published dozens of pieces in Harvard Business Review yourself, John, so you can imagine the shockwaves this caused. Now, after that, I launched my own firm with what is now 150 accounting experts, financial analysts, and support staff. This is around the world. And together, we run this forensic accounting analysis on 32,000 different stocks, and we publish the true earnings in full to the benefit of anyone who follows our analysis. In the case of Regions Financial that we've been talking about, for example, our clients could have made a 141% gain.
I can certainly see why your old bosses at Credit Suisse probably aren't too happy about you spreading your system to regular individuals.
Well, John, first, very few people are willing to bother with the forensic analysis because it takes extreme patience and it's a lot of time. It's tedious, but it's well worth the effort. So, for example, I once made personally a 669% gain in about a year and a half on a small company called VIP Shop after discovering what was essentially a $1.2 billion distortion in their financial statements. But of course, most people just want a shortcut to doing this. I get that. I mean, running the forensics on your own is about 1,000 times harder than doing your own taxes. So today, my team and I have written a full research report, and it's called Microcap Secrets: How to Make 100% to 500% Gains Using Forensic Analysis. And inside, it gives you a shortcut to using our approach, and it includes how to predict which microcaps could soon go up in bull or bear markets using true earnings and true earning power. Red flags that indicate a company may be headed for a crash. So in 2020 alone, we exposed a media stock that fell to zero with this secret. The one number you must get right when deciding whether to buy a microcap for 100% potential gains. And most important of all, we named the top 3 microcaps to buy now.
I know there are thousands of folks watching right now who are very excited to access your new report, but realistically, even a report probably isn't enough to get started, right?
John, our report gives you an overview of how our system works, but I agree, to do this analysis yourself on more than 32,000 companies, updated every quarter, and then knowing exactly which line items to correct, it's impossible for any person.
And that's why today you're stepping forward in a big way.
Yes. So John, up until recently, we mostly just sold our findings to professional investment advisors. And again, some of these folks have paid up to $100,000 a month just to see stocks with these huge earnings distortions. But today, we're doing something with our online system unlike anything we've ever imagined we'd do. We've launched a one-of-a-kind research service for everyday folks, and it's called Hidden Alpha. Now, alpha is a term used by Wall Street to describe an investment with outsized returns, returns that beat the market. And quite simply, it's the only place where where each month you can get the full details on which companies have real potential to make you 500% gains or more using our forensic analysis. So each month, we'll publish all the details of our newest recommendation, including how each stock fits into our system's view of the market as a whole. So most importantly, when the system says to sell, we will alert you on when to close your position for the biggest potential gain.
Okay, so in Hidden Alpha, you and your team show which companies have the biggest earnings distortions and what your forensics say.
So that's right. So we focus on mid to large cap companies, and we also publish special portfolios like the top 3 microcaps to buy right now.
And to be clear, for years, ironically, your best clients were Wall Street institutions who knew about these distortions but didn't want to perform this analysis themselves. But today, you're making the results of your system available in a simple, all-in-one product, more tailored for the general public.
Yes, John, we're tired of Wall Street having all the advantages, right? So after years of helping institutional investors get wealthier, helping the rich get richer, today we're leveling the playing field by giving you access to the same information we've provided Wall Street for years, but with the ability to get ahead of the smart money every single month. So today, for example, one of our newest recommendations is among the most promising we've seen in years. Now take a look. This is the return on assets for a small company in the video streaming sector. And frankly, it's not that impressive. But now, run the stock through the altimeter, and here are the real, true earning power numbers, more than 2 times higher. Even better, it's involved in a promising technology that could revolutionize the way we watch movies online. And that is a major catalyst considering all the companies who are trying to become the new Netflix right now. I urge you to buy this stock immediately. You could double or triple your money, but only if you buy it now before the public catches on to these numbers. And that's just one of the names in our fully built, done-for-you model portfolio of stocks we urge you to buy immediately.
Excellent. Now, in just a moment, we'll hold a demonstration of the altimeter. We'll show you the results of a variety of different popular stocks, including Joel's free recommendation of the #1 little stock to buy now and the #1 stock to avoid. But first, I want to make something clear. As Joel mentioned, for decades, his clients were institutional investors. These are the folks managing hundreds of millions to billions of dollars who make their living in the markets, and they don't have the time or the resources to do this kind of analysis on their own. They've been paying Joel's firm up to $100,000 a month. In other words, for 2 decades, unless you'd worked at a top 300 money management firm, more than half of whom have followed Joel along with the top 10 money managers, you'd have likely never known about the forensic stock analysis and how successful it is. But today, Joel is sharing a unique way for you to access the analysis and all of his top recommendations yourself to see which stocks are positioned to go up, which are positioned to go down, and most importantly, why. Each month, he'll name a company with the potential to double or triple your money as a result of the deeply nuanced analysis of the earnings distortions on Wall Street. And by the way, I'm a retired Harvard Business School professor and former senior partner at PricewaterhouseCoopers. I've taught at Oxford, the London Business School of Economics, MIT, Wharton, you name it. And let me tell you, I rarely endorse anybody, but the fact is, I've been using Joel's research for 20 years. And I can tell you that Joel's forensics-based analysis is an absolute must-have if you have any serious assets in the market. It's the only rational way I've seen to evaluate which stocks give you alpha, a serious edge in performance power. So as you can imagine, a lot of people have paid good money for Joel's work. For example, in the past, Joel has charged $2,000 for a complete monthly updated model portfolio of his micro-cap stock picks, and thousands of people have happily paid that price. But today, Joel is doing something special for everyone watching. In short, you can try his work risk-free. Typically, Hidden Alpha costs $199 a year, but because we are at a rare moment in history when historic sell-off across the market has created enormous uncertainty for most Americans, he's agreed to do something incredibly generous. If you order right now, you can try Joel's work risk-free for over half off the normal rate. You'll pay as little as $49 for an entire year. That's up to a 75% discount, and again, it's totally risk-free for anyone watching right now. That means you'll have the next 30 days to review Joel's special report and model portfolio. That model portfolio shows you which stocks could double your money by applying forensic analysis to company earnings. I think you'll find this offer more than pays for itself. As subscriber Chris H. writes, "Your track record speaks for itself. Nobody else comes close." And the Altimeter, what an incredible tool. In fact, one of Joel's first ever subscribers is Dave Daglio, a former chief investment officer at BNY Mellon, which has 1.8 trillion, that's with a T, trillion in assets under management. The best part, though, is that you can get all of this for less than the price of a casual dinner. And if you're unhappy, you can get a full cash refund of everything you pay today. To get started, simply click the link below this video right now to place your order. And keep in mind, we haven't even gotten to the best parts of this offer yet. When you join Hidden Alpha today, you also receive 3 incredibly valuable bonuses, beginning with one particular bonus that could show you how to make even more money with your subscription and change the way that you look at stocks forever. Joel, can you talk about that?
So John, it's simple. Through today's special offer, we'll also give you free access to the system itself for the next year. So you can type in any stock ticker in the S&P 500 and see its true earnings and see what's really going on inside the stock. So for example, let's do a live demo on some of the FANG stocks.
Sounds good. I'm personally curious about Facebook. They recently changed their name to Meta Platforms, which makes me question their entire business model. What does the Altimeter say?
All right, so John, type in Facebook, one click, and boom. That's the company's true earnings that have been more than twice the reported number, John. And that's why, up until recently anyway, the company had impressive profitability. In fact, our team recommended Facebook to our clients back in 2013 when we first noticed this. We corrected 50 distortions in the financial statements, and we saw a 1,300% gain on our recommendation. But then they changed the name to Meta, and they started pouring way too much money into this metaverse. This is a big, big mistake. The company has been underperforming on earnings. It's causing a huge drop in the stock as of late, even enough to make Jim Cramer cry on national TV. In fact, we specifically recommended selling Facebook on October 5th, 2021. That was almost the exact top. It's down over 66% since then, since our recommendation to sell, as Mark Zuckerberg realizes that no one really cares about the metaverse. So this is what I mean by worrying about a crash within individual stocks or sectors rather than a market-wide crash itself. So in this case, the growth in Facebook just isn't there anymore. So I'd recommend you avoid this company until those fundamentals look a little, maybe a lot better.
Okay, can we move on to Apple?
All right, so type in Apple, and lo and behold, another massive earnings distortion. There's a reason why this stock has had such a fantastic run, and they're minting cash year after year.
That's wonderful. And finally, Netflix.
All right, Netflix we looked at earlier. The true earnings are 5 times higher than the reported number, John. And after a significant sell-off, the stock is up almost 50% in the last few months. I mean, granted, the market's worried about this commodity business that was slowing down, but our metrics have shown returns are still very robust. So at this point, I think Netflix might be an interesting stock to watch. But to be honest, you're much, much better off putting your money to work in the microcap stocks we're recommending. Again, these stocks are smaller, so they have a lot higher profit potential than Netflix. In fact, besides the multi-baggers we've already recommended, we recently backtested our system across the entire universe of microcaps to see exactly how much money you could have made in this kind of volatile market. And the results, they blew us away. Just take a look. Altogether, you could have made 10 times your money on 7 different occasions by applying our forensic analysis to microcaps, and more than quadrupled your money 17 different times. This is where to put your money right now if you want 500% to 1,000% upside, not the FANG stocks.
Amazing. There you have it. Order now before today's offer expires and receive 1 free year of access to check out any of the S&P 500 stocks in the Altimeter system, so that you can plug in your own large cap stock ideas and run this kind of analysis on almost any company, industry, or trend. And of course, you'll also receive up to 75% off Hidden Alpha and 2 more bonuses we haven't even covered yet. Not to mention, you can try all of this 100% risk-free. But today's offer, the best offer with all the bonuses, could be taken down at any time. So if you're interested, we urge you to place your order right now. Click the link below this video to get started, and keep in mind, even folks who've worked on Wall Street have openly praised Joel's work. For example, we heard from Matt Rakowski, a former head of credit at Goldman Sachs. He recently said, Joel Litman's forensic analysis has brought me significant gains in my own portfolio. Some of the stock ideas are really incredible, with huge upside and long before the rest of the street sees it. Now, Joel, I want you to run your system on two of the most talked about sectors of late, with all of the big shakeups that we have seen, and that is gold and also oil. But real quick, let's talk about your refund policy. And if you're a subscriber to Hidden Alpha and you're unhappy, what do you do?
All right. Well, the biggest reason I'm doing this is because I want to help other people. So that's where we're making this offer. It is completely risk-free. So if you're unhappy with my work, simply contact our college-educated customer service team at our 1-800 number, and you'll get a full, prompt, cash refund of everything you paid.
Although, frankly, I doubt you'll ask for a refund. And Ruiz L. writes, overall, it's by far the most powerful stock analysis service I've subscribed to. And we also heard from Dr. David Eifrig, a partner at the largest independent financial research firm in America. He's a medical doctor who once worked on the trading floor at Goldman Sachs, and he says,
Joel Litman has incredible insight into the accounting and how businesses and firms truly operate. Joel has just got this incredible insight both into numbers and then how businesses thrive. I mean, I just think Joel Litman is one of the most exciting things to come around for me in the investing space in my lifetime, truly. He's actually given lectures to folks around the world at really the prestigious CFA societies. If anyone knows about that, Chartered Financial Analyst Group, Joel runs around all over the country. In fact, I think as I'm filming this today, he's in Japan speaking to the CFA Society in Tokyo. We were looking at a company the other day with him, and it's one that I've been eyeballing. When he showed me and looked at his numbers, I immediately emailed my team and said, we have got to buy this thing. This looks fantastic. And so just a quick peek under the cover at some of his analytics, I think will give you insight into your own investing, and I think will create opportunities. He's got Wall Street, big players on Wall Street following him. I am super excited. He's got the MBA from the same place I went to. He thinks about strategy. He's looking at the whole picture, distilling it down to this fantastic system which he provides and has really changed my investing in the last couple years.
And by the way, once you get in, don't be surprised by the wealth of information you'll receive. Joel puts an extremely high level of energy into everything he does, not just with the investment world, but even his own personal life. For example, and I love this, when Joel wanted to learn karate, he studied with a Kyokushin karate champion who held a world record for breaking blocks of ice. When he studied the Thai kickboxing, he sought out and studied under a 4-time world heavyweight champion. In other words, Joel Litman is exactly the kind of guy you want working on your behalf because he never takes any shortcuts. He goes to the absolute limit in everything he does. And that's why Joel and his company, Altimetry, are releasing the special offer for his breakthrough investment research service, Hidden Alpha. Simply put, he wanted to take what he was doing for institutional investors and make it available for retirees, small business owners, and anyone in America who wants the chance to see serious gains this year, no matter what happens next in our market. I only wish I could have had Joel in the classroom back with me when I taught at Harvard Business School, because this is just a fantastic example of how you give yourself a huge edge over the establishment, not by working harder, but by working smarter. That's one of the most important principles I try to instill in my students. And with that, Joel, let's get back to your altimeter. What does the system say about gold stocks right now?
So John, earlier I told you to avoid gold stocks, and here's a good example of why. If you're worried about inflation and think of buying gold stocks, you'd probably consider a name like Yamana Gold. This is a gold miner. But run the stock through our system, ouch. I mean, Wall Street would like you to believe that this return on assets is 4%, but in fact, it's actually 0.5%, John. It's almost zero. So I'd say investing in this stock right now is a fantastic way to lose money. Don't go anywhere near it, and the same goes for most other gold stocks, frankly.
So forget gold entirely?
Forget gold, because even if you think the financial system is a mess, you're better off playing the banks. For example, consider the fallout from 2008. Yes, you could have bought gold and done reasonably well. It went up 125% after the financial crisis, right? But instead, our system analyzed the financial sector, and we found a 417% earnings distortion in the company LendingTree. Now, they specialize in mortgages. Our system found this distortion in 2013, and we saw it continue for the next 6 years. If you'd acted on it at the beginning, you'd have made up to 2,302%, John. Wow. 18 times more money than owning gold over the same time span.
What about oil? I mean, oil prices hit an 8-year high in 2022. Surely I could do well by owning a stock like ExxonMobil or Chevron, right?
Well, let's find out. So type ExxonMobil into our system. Boom. This company looks sluggish, John. They're reporting a paltry 5% return on assets to Wall Street, and the true earning power number is actually worse than that. To buy this stock right now is pure gambling.
Is the same true of Chevron?
Let's look. Almost the exact same picture, John. A negative return on assets posted on Wall Street, with the true earning power number being slightly worse than that. Now, granted, there's some companies in the oil and gas industry we think are really compelling right now. There are, right? In fact, we're recommending 3 of them in a hidden alpha. But just following Exxon and Chevron is the absolute wrong way to get involved in that corner of the market.
And with that, I want to talk about the second bonus you'll receive if you take advantage of Joel's special offer right now, today. As you've seen, Joel and his team are masters at using their system to pinpoint which stocks could soon plummet, especially important in this kind of jittery market we've seen lately. For example, Joel and his team once exposed 57 companies as stocks to avoid, of which 50 fell in price, with many that crashed, went bankrupt, or fell to near $0 a share within months of their analysis. And this was during the height of the bull market. Take a look. That's why you'll also receive a free special report called Top 3 Popular Stocks to Avoid Now. Joel, can you talk about that?
So sometimes, John, it's just important to see which stocks could lose you money as which could make you money. And for me, this is very personal, because as a forensic accountant, I have a special interest in companies whose earnings are not only worse than posted on Wall Street, but are engaged in some kind of potentially fraudulent or deceptive behavior.
If I remember right, you're a member of the Association of Certified Fraud Examiners. Is that correct?
I am, yes, and I've spoken at the National FBI Forensics Conference. You wouldn't believe the things we've been sharing with the FBI and others. For example, we once had a wealthy client who invested $6 million into this company that had a ton of hype. There's so much hype. Months passed with no word. He started getting nervous. He hadn't done any deep analysis of the company, so he asked my team to really get in and dig in and investigate. We ran our analysis, and we made a discovery even worse than the exaggeration of an earnings report. It turned out, 1, the company's headquarters were just a vacant lot behind one of the board members' homes. And 2, that board member was a former Miss America contestant who'd been dating the chairman of the board at the time. So in the end, this dirtbag executive was sentenced to 12 years in jail. And we are really happy that we helped identify this fraud. And this is nearly 3 years that we saw it before the SEC finally jumped in.
To me, it's just incredible that this kind of sleazy stuff actually happens in the real world and not just in some kind of movie.
John, the problem is the source of the numbers themselves. For example, consider Harry Markopolos. This is the guy who uncovered the Bernie Madoff fraud more than a decade before it went public. And he said the problem with investors is they trust the accounting firms, which you should never trust because they're incompetent. On a best day, they're incompetent. On a bad day, they're crooked. So as a result, most people have no reliable way of knowing which stocks have the highest potential and which ones are absolutely worthless.
So what is it that's wrong with these accounting firms?
So the companies that are trying to dupe investors, they'll often deliberately hire the worst, most inexperienced auditors. They're hiring accountants who are poorly rated, and they're even negligent. And as a result, they make big mistakes that don't even get caught. So as the Harvard Business Review actually once put it, even the most honest and meticulous of auditors can unintentionally distort the numbers in ways that mask a company's true financial status, thereby misleading investors.
And with all of this, the government hasn't stepped in?
Actually, it's gotten so bad that the government finally mandated a group called the PCAOB. This is the Public Company Accounting Oversight Board, an oversight board, right, that literally audits the auditors. And yet, the biggest mistakes, they still go unnoticed by most. For example, that company you mentioned earlier, Bright Mountain Media, which fell almost 100% after we exposed it. One of the red flags we found was that their auditor, this firm Eisner Amper, was also once the auditor of Equitas Management and was also involved in Equitas's Ponzi scheme from 2010 to 2016. This is a Ponzi scheme that the auditor was involved in. You can't make this up.
What are some of the other ways that you try to find out if a company is cooking the books?
All right, so John, take this company, NantQuest, for example. It's a small biotech firm, and it's searching for the cure to cancer.
The cure to cancer? Wow. That sounds like something that might be trouble right there.
Right. So, well, surprisingly, and maybe not, the stock jumped 60% at first because of all this hype. Now, we ran our forensic analysis, and we made this disturbing discovery, and it turned out the company was nothing but a shell. It was a holding company for the CEO's various other businesses, and he was funneling shareholder money basically directly to his own pockets, John. As a result, the stocks plummeted 45% after we exposed it. So that's why, again, as part of our big prediction for the market, we've compiled the top 3 popular stocks to avoid now in a new special report. Whether they're engaged in deceptive activity or maybe they just have real, truly poor earnings, some of which you might own, because it's often a big surprise to the public as to which companies are actually losers just dressed up in some hot story.
All right, well, you have to give us an example.
All right, so John, there's this company, nanoviricides. So back in 2020, companies are working on a cure for COVID-19. They received a lot of attention. So some of these companies like Moderna or Pfizer, I mean, they're doing legitimate vaccine work, but many were not. So one company in particular that caught my attention was this currently Connecticut-based firm, nanoviricides. These guys claimed to be developing a vaccine for COVID. But John, if you look back at their public filings, they said the exact same thing about finding a cure for Ebola virus. Then they said it for the West Nile virus. Then they said they're going to do it for the avian flu. I mean, you name it. So every time there's a health crisis, they claim to be working and they're about to find a cure.
And I imagine a bunch of people got suckered in back in 2020.
Sadly, yes, and it even gets worse. So in one of their public filings, the research head claimed he'd attended Harvard University. But just a few quarters later, mysteriously that Harvard line vanished from their public filings. And then instead, it turned out to be some random school frankly, in a third world country. So in fact, I publicly warned about this company in July 2020. Can we run this? Can we run that clip? In fact, the SEC recently halted trading of several companies that claim to be developing a coronavirus vaccine. One company in particular is arguably the biggest piece of garbage I've ever seen, and it's called nanoviricides, right? These guys, claim they've developed the vaccine for coronavirus. But Jared, if you look back at their public filings, at their actual press releases, they said with almost the same grammar and the same sentence structure, they said the same thing when they were announcing that they were planning on having a cure for Ebola, for SARS virus, for the avian flu. Like every time there's a virus that comes out, they say, oh, we potentially have a fix, and not once have they ever come out with a cure.
That's really nice work. Now, keep in mind, normally Joel's clients have paid as much as $20,000 to $100,000 just for these models' super bear portfolios of stocks poised for a fall. But you'll receive this new report free of charge with your subscription, along with your 1 free year of access to large cap companies on the Altimeter and everything else we've discussed today. And of course, this entire offer comes 100% risk-free. So if you haven't already, we urge you to click the link below this video and order now, today, to receive this generous and enormously valuable bonus. Now, Joel, before we sign off, I know you're still going to give away your free recommendation, but real quick, let's do a live demo on one of the most talked about sectors in America right now, and that's semiconductors. In 2021, there was concern about a shortage of facilities in America that can manufacture chips for computers. It got so bad that President Biden called this out in his State of the Union address. And he even invited the CEO of Intel to sit in the audience. Intel is at the center of a new drive to bring back this sector to America, according to Biden. So tell us, is Intel a buy right now?
Well, so John, let's check it out. I remember all this. So run Intel through the system, and with one click, boom. What you see is Intel's real earning power has been decreasing for years, each year, John. The true number, frankly, is only slightly better than the as-reported number. This stock is actually getting an F grade in our altimeter, and it's no surprise. Because after all the discussion about semi-shortages in 2021, now there's a new concern that we maybe have too much supply, right?
Boy, that's interesting. So does that mean we should avoid the semiconductor industry entirely right now? I mean, I guess it'll take a while for supply and demand to balance out.
Not necessarily, John, because there's another semiconductor stock that actually looks a lot better right now. That's Qualcomm. Now, I want you to take a look. Now, the CEO didn't get invited to Biden's State of the Union like the Intel CEO, but Qualcomm has been minting cash. In 2020 alone, its earning power was nearly double the number that Wall Street would have you believe is true. And no surprise, it's actually getting an A grade in the altimeter, unlike Intel.
Man, I really love how the altimeter can flip these stories around and show you what's really going on inside a stock or a sector. Thanks for that. And I think it's really powerful that, in addition to showing the earnings distortions by year, you've also made it easy to see which stocks will do best by assigning each one a simple grade from A to F. As a former Harvard professor, I love the simplicity of that.
So yes, John, we assign a grade of A to F, and these include all the various aspects of our forensic analysis. And by the way, here's something interesting, right? Currently, of the 6,000 plus stocks in the full altimeter, only 305 get an A grade, where nearly half of all companies get a D or an F. That means there's a good chance your portfolio is full of some ticking time bombs that you have no clue about.
And don't you also run something you call the truth detection? It sounds to me more like lie detection, but you do something very unusual when it comes to evaluating which stocks could actually make you money. Could you walk us through that real quick?
So John, take Under Armour, for example. This is the sports apparel company, right? They had a lot of potential when they first started out, with some people predicting they're going to rival and take over, be bigger than Nike. But then, look what happened after it went public.
Seems like the stock just fell off a cliff.
By the summer of 2019, the stock looked pretty cheap, like a lot of the companies you see after a crash. So like many of the stocks out there today, in fact, right? So some people thought this might be a great place to buy, I'm quoting. But remember, there's a reason why some companies are cheap. They're cheap because they don't have the future, right? So this is a very important point I want to emphasize, by the way. Some companies are cheap, and they do go on to rise 10-fold, 20-fold or more, and other companies are cheap, and they go on to hit zero. Forensic analysis is what's helping us separate one from the other.
That's a very good point, especially in today's battered market.
Right, John. So even outside microcaps, there are some extraordinary companies right now that are trading at historically cheap prices, which are all fantastic buys you might never see again at these levels. But others are just plain garbage that deserve, frankly, the reckoning that they've received with this recent sell-off. And that's why the rewards can be so huge in the microcap market if you can separate the winners from the losers. And in this case, getting back to Under Armour, we conducted what we call, what you were asking about, our earnings call forensics.
Could you explain what that is?
So I once got invited onto a CNBC segment, and it was called How to Decipher If a CEO is Lying. That's because my team and I have expanded our system to include algorithmic audio analysis. It's an electroaudiogram. Now here's an example of what it looks like. In short, once we run the numbers, we also analyze the earnings calls themselves to see whether or not the words that management is saying match the numbers that we're revealing.
You mean you're trying to see if someone's lying?
I don't want to use the word lying, because instead what we're really looking for is clues that management tells us whether they're concerned. It's not just lying, it's any kind of emotional affect. We want to see if maybe the results are even better than they're letting on because they're actually excited, right? There are dozens of red flags and green flags that we can see when executives are trying to hedge or when they're trying to hide something. And what we've learned by analyzing the actual audio calls of more than 30,000 different companies over the last 2 decades is how to do this kind of analysis. And it's similar to what we did in 2014 when we were analyzing an earnings call of Google, of Alphabet.
And what did you find there?
We were hearing Google executives expressing a lot of doubt inside their conference calls. And they were changing their tone, they're changing the way they hesitated, they're changing their vocal patterns in a number of troubling ways. So in this case, we found that Google's CEO was specifically hesitant when he talked about the company's conversion to mobile. We felt he was overemphasizing the boost that Google could actually get from this mobile e-commerce.
So because of that, you avoided the stock?
We sure did. And yep, sure enough, shares of Google were flat for the next year. It just didn't turn out as good as they were saying. So getting back to Under Armour, we did the same thing. Back on July 25th, 2019 specifically, we dialed into the company's earnings call. And of course, management was trying to sound upbeat. You know, they always want to paint a pretty picture.
Yeah, but you thought in this case it was bogus.
So in this case, we felt that in truth, they were very, very concerned about their growth opportunities. So we issued an immediate warning to our clients, and sure enough, the stock dropped 48% within a month. And what's great about the altimeter and our research is that we can often predict both the rise and the fall in a huge variety of stocks, often within months of each successive movement. So for example, our system once found a big positive earnings distortion in the cannabis firm Tilray. This is just before the stock rose 514% in 2 months. Then the following year, it found a negative distortion that was just before the stock went on to plummet 92%.
If your system can spot these kinds of movements out of the blue, you must see a lot of oddball ideas.
Oddball is right, we do, John. So for example, another stock that showed up in our system was a buy is Axon. Now they make tasers of all things. I mean, their clientele are basically police departments.
Not exactly cutting edge technology.
No, but in 2015, this company had this huge earnings distortion that oddly was growing bigger and bigger with each passing year. So the point was the public number was turning negative even as the true blue earning power number was increasing. Now you could have made up to nearly 6 times your money if you just held your nose and bought the stock.
Really, how can the government allow for such major accounting distortions to continue? I mean, wouldn't they have demanded a revision of the rules by now?
John, that's the crazy part. FASB, the Financial Accounting Standards Board, the committee that sets U.S. accounting standards, is historically made up of a number of people, right? At one point, it was 7 people. And to create a new standard, they needed a majority vote. So back in the late 80s, right, 3 of the committee members were all voting against the GAAP rules for the statement of cash flows. So of 7 members, 3 said, this is wrong, that the statement of cash flows, the way it's reported to everyone, to the public, right, they denounced it. The 3 of the FASB members, I mean, these are great accountants in their own right, were saying it's internally inconsistent. The statement of cash flows, they actually said it was confusing. They said it would confuse investors. And incredibly, they were overruled by 1 vote, a 4-3 vote, and you know, you've seen what happens.
That's amazing. So trillions of stock market money is being moved around based on earnings announcements. Yet, it's impossible to get a clear picture of those earnings unless you're one of the few people who actually understands or even cares about an accounting system that has been broken for 4 decades.
That's exactly right, John. Yeah.
You know, to me, that's the kind of thing I always tried to warn my students about at Harvard. Always look out for people who are hiding the truth, because in this case, accountants are literally punishing innovation, and people are overlooking huge investment opportunities because of that.
Yes, and it's bad news for anyone who cares about transparency. It's great news for everyone watching this, because if you can take advantage of these distortions, you can make a lot of money.
And that brings us to the 3rd bonus you'll receive if you take advantage of Joel's special offer right now, today. In short, Joel's system has drawn so much attention that he's spoken on CNBC and been featured in Forbes, Seeking Alpha, and spoken to packed rooms at CFA societies around the world, including a memorable lecture where he once gave in Berlin that accurately called for a collapse of BMW stock. And as we mentioned, he's been invited to teach his analysis to the FBI in the same room where they plan SWAT team missions. In recent years, he's been invited to the U.S. Pentagon a number of times where he used his forensics to debunk the myth that China will overtake the U.S. economy. According to his analysis, it's exactly the opposite. And he's been a regular guest lecturer among the faculty of Harvard University. And it was at the Harvard Club in Boston on a casual summer day in 2019 that he once delivered a lecture that has since become legendary in our industry. During a luncheon with Harvard faculty and students, Joel aired and exposed why certain stocks go up by 1,000%. In fact, I was there that day, and let me tell you, Throughout my career, I've met everyone from the guy who invented the spreadsheet to the guy who invented the high-speed backbone of the internet, and this was one of the most informative talks I've ever witnessed. Thankfully, the lecture was filmed and has become a must-see for hundreds of people who have paid good money to access it. Joel could easily charge $1,000 to access the recording, but you'll receive it free of charge through today's special offer. And of course, this entire offer comes 100% risk-free. And with that, we've come to the big announcement. Joel, what's the free recommendation you've promised to give us today?
All right, so take out a pen and write this down. In short, I recommend you buy Qualcomm, which we talked about earlier, ticker QCOM. It's long been one of the most essential companies in the entire world of smartphones, and now it's becoming essential to all the other things you use in your daily life. For a long time, investors were caught up in tracking how many units Samsung and other smartphone makers were selling because they mistakenly thought that was the biggest driver for Qualcomm's value. I mean, at one point, maybe it was, but that stopped being the case literally 2 years ago. Because today, the company sits at the heart of supplying chips to the Internet of Things. So as more and more of the devices we use every day need access to the internet to access more and more data, whether it's your smart fridge or your assisted driving features in your car or industrial machinery that can take directions from engineers that are literally countries away, more and more things need the exact chips that only Qualcomm is set up to provide. And because of that, and especially considering Wall Street has dismissed Qualcomm as just another struggling chip maker, I'm quoting, we think it's going to be a huge winner. And for years now, its true earning power has been up to double the reported Wall Street number, a trend we think will continue. So buy the stock immediately.
Okay, we know the upside. Now, what's your number one popular stock to avoid?
John, it's ExxonMobil. It's the wrong way to play rising oil prices. There's a reason this stock got booted out of the Dow back in 2020 after being there for 92 years. The earning power just isn't there anymore.
That's simply amazing. So there you have it. Joel Litman, a forensic accountant who's developed a one-of-a-kind way to see earnings distortions in over 5,300 different stocks before the public has a clue. This gives you a chance to make multiple times your money. He'll reveal this kind of information every single month in his best-selling Hidden Alpha. Order right now and get up to 70% off the price, along with free access to his S&P 500 altimeter system for the next year. Plus, you get his model portfolio of the top 3 microcaps to buy now, plus free access to his bonus report, top 3 popular stocks to avoid now, plus his full research report, Microcap Secrets, how to make 100% to 500% gains using forensic analysis, and his free lecture at Harvard University, and that's not all. If you get in right now, today, you'll also receive a special mystery gift we didn't have time to cover in today's event. Other people have paid upwards of $73,000 to access the source of this gift, which I was personally involved in creating. And let me tell you, you don't want to miss it. And again, this offer is totally risk-free for anyone watching right now. That means you'll have the next 30 days to review and look at Joel's special reports, his system, and his model portfolio, which shows you which stocks could double your money using forensic analysis of company earnings. Just keep in mind, this special offer, with all of the bonuses we've discussed today, can be taken down at any time. So to secure the best possible deal, we urge you to order now. To get started, simply click on the link below this video. So Joel, any last words?
Yes, don't ever make another investment ever again by relying solely on public reports, especially in the kind of jittery market we've been seeing lately. The reported earnings for almost every stock contain massive distortions. You can either rely on the same information as everyone else and try to guess where the next stock is going, right, which is very difficult in this confusing and volatile market we're seeing today, or you can use the secret weapon, right, the secret we've been showing you today, to spot these distortions before the rest of the public has any clue, before they get corrected by the market, and you see the truth of any stock in any type of market, whether it's a bull or a bear. And right now, we're facing a once in 19 years CapEx and supply chain supercycle that will send very specific companies soaring. To ignore this opportunity and get sucked in by all the fear-mongering being spread on Wall Street right now and the media, be it fears of a crash or inflation or geopolitical conflicts or the Fed, right? To miss the kind of gains we plan to show in Hidden Alpha will amount to nothing less than a financial disaster for your portfolio. Please don't make that mistake.
Thank you, Joel. And with that, place your order right now for the best possible deal. On behalf of Altimetry, I'm former Harvard Business School professor John Sviokla. I hope you enjoyed watching, and thank you for joining us.